The Treasury operates in the exchange market, money market and securities market using various products to cover customer transactions and to take positions within the risk limits set by the management of the bank. The Treasury also invests in short-term funds like Treasury bills, commercial papers, certificates of deposit, repos and collateralized borrowing and lending obligation (CBLO). The Treasury may also trade in securities to profit from price movements. In this unit, you will learn about products of the Forex market, money market products, securities market products, domestic and global markets.
The foreign exchange or Forex market is the most liquid market in which participants can freely buy, sell, exchange and speculate on currencies. Free currencies belong to countries whose markets are highly developed. Currencies which are partly convertible have limited demand and may not be traded actively. However, currencies like the Indian rupee, though partly convertible, enjoy high liquidity owing to a large domestic market and a high growth rate of the economy. Forex markets are made up of banks, commercial companies, central banks, investment management firms, retail forex brokers and investors. The forex market is considered to be the largest financial market in the world and is highly liquid.
Most of the transactions in the forex markets take place online. This ensures that information dissemination is quick.
This is a near-perfect market due to the efficient price discovery system. Some of the products of the Forex market are as follows. Click each button to learn more. Money market products like T-bills, commercial paper and bankers' acceptances are short-term, fixed-income products that do not exceed a year and that are sold at a discount and then mature at face value. Though interbank markets are called risk-free markets, banks still possess a counterparty risk in them too. The interest rates of the interbank markets are sometimes called benchmark rates, as they have very low risk, second only to sovereign risk. The Treasury invests surplus cash into the money market after meeting the cash reserve ratio, currently 6%, given by the RBI. The interbank market is divided into the following products. Call money. This is the money loaned by a bank that must be repaid on the next working day. It indicates liquidity in the interbank market. Notice money. This is the money loaned by a bank that must be repaid within a period of 14 days. Term money. This is the money loaned by a bank that must be repaid within a period of 1 year. It normally ranges from 1 month to 6 months. The securities currently available for placement of short-term funds are shown in the accompanying figure. These are explained in greater detail in subsequent screens. Click each highlighted circle of the image to learn more. Treasury bills are promissory notes issued at a discount and for a fixed period to raise funds to meet expenditure needs. They are also used to provide an outlet to park temporary surplus funds by investors. Currently in India, Treasury bills are issued for 91 days, 182 days and 364 days. The interest is calculated by way of discount and is market determined based on the demand and supply of funds in the money market. Bids for Treasury bills can be made for a minimum amount of Rs 25,000 and in multiples of thereof.
The Treasury bills are issued in the form of a promissory note in the physical form or by credit to the subsidiary general ledger, SGL account, or to the GILT account in a dematerialized form.
The RBI sells Treasury bills on auction basis by calling bids from banks, the state government and other specified bodies. This process is done every fortnight for bidders that quote above the cut-off price fixed by the RBI. Bids are submitted in terms of price per Rs 100. For example, a bid for a 91-day Treasury bill auction could be for Rs 97.50. There are two types of auctions for Treasury bills. Click each button to learn more. Banks, corporations, and foreign governments commonly use this type of funding, which is mainly issued by companies, primary dealers, and financial institutions. A minimum credit rating of P2 from the Credit Rating and Information Services of India Limited, or CRISIL, needs to be obtained by participants. They have the option of obtaining an equivalent rating from the other agencies if required. On doing so, a CP will be issued at a discount to face value as may be determined by the issuer. A CP can be issued in denominations of Rs 5 lakhs or multiples thereof. The amount invested by a single investor should not be less than Rs 5 lakhs face value. A CP can be issued either in the form of a promissory note or in a dematerialized form through any of the depositories approved by and registered with SEBI. The CP carries relatively low credit risk due to its short-term nature and minimum credit rating requirement. Click the button to learn more. A CD is issued by banks which bear a higher interest than the regular deposits of the bank. CDs attract stamp duty and are rated by credit rating agencies. Scheduled commercial banks accept rate reduction bonds, RRBs, and all India financial institutions within their umbrella limit can issue CDs. Cash reserve ratio or CRR or statutory liquidity ratio SLR is applicable on the issue price in case of banks. Investors include high net worth individuals other than minors, corporations, companies, trusts, funds, and associations. The maturity for such CDs is a minimum of 7 days to a maximum of 12 months. In case of financial institutions, FIs, it is a minimum of 1 year and a maximum of 3 years. CDs are issued for a minimum amount of rupees 1 lakh and in multiples of rupees 1 lakh. Interest rates are market related and can be either fixed or floating. Repo is a securities transaction used for lending and borrowing money market funds for terms extending from 1 day to 1 year. Repo refers to the sale of securities with a commitment to repurchase them at a predetermined date and rate. Under a repo transaction, the forward clean price of the bonds is set at a level different from that of the spot clean price in advance. This is done by adjusting the difference between the repo interest and the coupon earned on the security. Repo transactions mainly deal with government securities. The effective interest rate on repo transactions is marginally less than the corresponding money market. Repo settlements are routed through the Clearing Corporation of India Limited, or CCIL. Government securities are actively traded. Monetary policy can either be expansionary or recessionary in nature. Under an expansionary policy, the policy makers increase the money supply in the economy by lowering interest rates. This is done mainly to boost economic growth and decrease the level of unemployment. The monetary policy regulates the supply of money and the cost and the availability of credit in the economy. It deals with both the repo and reverse repo rates. In case of shortage of funds, the bank sells government securities to the RBI, thus increasing the funds. In case of excess of funds, they buy back securities from the RBI in exchange of cash. The difference in purchase and sale prices constitutes the interest paid or received by the banks. The Liquid Adjustment Facility, or LAF, of the RBI is intended to primarily meet the day-to-day liquidity mismatches in the system. Under the LAF scheme, repo auctions for absorption of liquidity and reverse repo auctions for injection of liquidity were introduced on a daily basis, except on Saturdays. Repo rates set the upper band and reverse repo rates set the floor for the money market. A borrower can deposit government securities with the CCIL and borrow against such securities from those having surplus liquidity. CBLO creates an obligation on the borrower to repay the money borrowed along with interest on a predetermined future date. CBLO is basically a repo instrument and is actively traded in the secondary market. In this form of short-term security, the Treasury discounts bills of exchange which are already discounted by another bank. The rediscounting is calculated close to the money market rate and is usually negotiated between the lending and the borrowing bank. When there is a low liquidity in the market, banks can generate cash by rediscounting short-term securities. Also, the lending bank can invest surplus funds at term money rates with low credit risks.
There are a few investment products available to bank treasuries. They are briefly described here and will be explained in detail in subsequent screens. In order to comply with the reserve requirement of the bank, statutory liquidity ratio or SLR, the Treasury invests in government securities. The RBI can increase or decrease the SLR as a part of the monetary policy in order to control the money supply in the market. The SLR is currently at 25%. In order to satisfy the SLR, banks can also hold cash or gold or invest in other approved securities such as bonds issued by Small Industries Development Bank of India or SIDBI and National Bank of Agricultural and Rural Development (NABARD). Government securities are either short-term, usually called treasury bills with original maturities of less than 1 year, or long-term, usually called government bonds or dated securities with original maturity of 1 year or more. Click each button to learn more. Corporate debt papers are non-SLR securities and are highly liquid, as they are actively traded in the secondary market. Tier 2 capital bonds issued by banks fall under this category. Corporate bonds face credit risks depending on the credit rating. The higher the credit rating, the lower will be the yield. However, the yields on bonds and debentures are higher than that of government securities. In India, debentures are generally issued by private sector companies, whereas bonds are issued by institutions in the public sector. Click each tab to learn more. This type of bond initially makes regular payments of coupon and principal. However, the bondholder can convert it into equity shares of the company if they wish to. A bondholder would usually convert a bond into shares if the market price of the shares is greater than the exercise price, the price which the issuer would give to bondholder. This kind of bond is advantageous to the issuer as the coupon payments on the bond are lower for the company, thereby reducing its debt financing costs due to the equity side of the bond. When the bond is converted, the equity holding of the existing shareholders gets diluted. The Indian equity market is more popularly known as the Indian stock market. The Indian equity market has become the third largest in the Asian region after China and Hong Kong. The Indian market has 22 stock exchanges. The larger companies are enlisted with the Bombay Stock Exchange or BSE and National Stock Exchange NSE. The smaller and medium companies are listed with Over-the-Counter Exchange of India or OTCEI. The Securities Exchange Board of India, SEBI, is responsible for supervising the functions of the equity market in India. Major investors in the domestic market include foreign institutional investors, mutual funds, insurance companies, and private fund managers. There is constant interaction between domestic and global markets wherever funds can be swapped from one currency to another or where funds can be transferred from one market to another. Some points of interaction between the domestic and global markets are described as follows. Click As you study the subject, it will help read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. Read the instructions on screen to complete this exercise. In this unit, you have learnt the following. Foreign market operations include spot, forward and swap trades. The foreign market is considered a perfect market as well as a liquid market. The primary function of the Treasury is to manage liquidity and meet with the CRR requirement. Money market products include T-bills, commercial paper and bankers' acceptances. These are short-term fixed income products not exceeding 1 year that are sold at a discount. In order to comply with the reserve requirement of the bank, the Treasury invests in government securities. Liquid adjustment facility is used by the RBI to inject liquidity into the banking system. Securities market products include government securities, corporate debt paper, equities, debentures and bonds. A convertible bond makes regular payments of coupon and principal and can be converted into equity shares of the company. You have now come to the end of this unit. Answer these questions to see how much you know about the concepts you have covered in this unit. Go through the unit again in case you have doubts.